All right, let's jump right in. There is a brand new IRS rule on the books, and honestly, it could put thousands of dollars back into the pockets of seniors. What surprises me is how few people are talking about it, because this is not a tiny tweak. This is not a footnote. This can materially change taxable income for millions of retirees. So if you're 65 or older, you're going to want to listen very closely. What we're about to cover could change how you manage your money in retirement for the next 4 years. I want to emphasize that 4 years, not forever. For a window like that is like a sale that expires. You don't buy nonsense just because it's on sale, but you also don't ignore a legitimate discount on something you already need. This is really important stuff, so let's get to it. The big question is simple. Is there really a new way for seniors to save on their taxes? And the answer, believe it or not, is a big resounding yes. But look, this isn't just some little annual adjustment. We are talking about a major shift in how much of your income can be protected from federal taxes. And if you miss out on this, it could cost you thousands of dollars that should have stayed in your wallet. Not because you did something wrong, but because you didn't claim what you were allowed to claim. Here is the number that should make you sit up and pay attention. $12,000. That's the potential new bonus deduction for a married couple. Both 65 or older, filing jointly. Now, if you're a single filer, it's still a whopping $6,000. And I want to be very clear. This is not a gimmick. This is not a sweepstakes. This is not a trick. This is a real deduction that can lower taxable income. And lower taxable income can mean lower taxes, sometimes much lower. I've watched people obsess over earning an extra 1% in the market, but then they ignore a deduction that could save them $1,000 or more in a single year. That's backwards. You build wealth by making good decisions repeatedly, and taxes are one of those decisions, because investing is what you do with what you keep. So what exactly is this new benefit? Let's break it down in plain English. In this first section, we're going to call it a new senior deduction. We'll cover what it is, where it came from, and why it's such a potential game changer for so many retirees. The official name being used is the senior bonus deduction. You may also hear it described as an enhanced deduction for seniors. It's temporary. It's specifically for taxpayers who are 65 and older, and it was part of a larger package of tax changes. Now here's what makes it powerful. This is the key point. It stacks. Let me say that again. It stacks. This bonus deduction doesn't replace what you already have. It doesn't erase your standard deduction. It doesn't erase the extra deduction you already get just for being over 65. It sits on top. It's like building blocks, base plus another block, plus a big new block. And stacking is the reason the totals get so large. Now I want to clear up a common misunderstanding early. A deduction is not a credit. A credit reduces your tax bill dollar for dollar. A deduction reduces the income that gets taxed. So a $6,000 deduction does not mean $6,000 in your pocket. It means $6,000 less income is subject to tax. And your actual savings depends on your tax bracket. But do not underestimate it, because when the deduction is large, the savings can be meaningful, especially in retirement, where a few $1,000s can cover real necessities. Now, let's move on to the real-world numbers. This is where people start paying attention, because this is where you see how much income could be protected. Let's do the math for a single person who's 65 or older. For the 2025 tax year, the standard deduction is projected to be around $15,750. Now, because you're over 65, you already get an additional age-based deduction. In this example, that is about $2,000. Now you add the new piece, the senior bonus deduction. That is $6,000, so you stack it. Standard deduction plus the age-based deduction plus the $6,000 bonus. and that totals about $23,750. Just let that sink in. That is almost $24,000 protected from federal tax before you even start. Now I want you to think like an owner for a moment. If a business had a legal way to protect $24,000 of income from tax, would it ignore it? Of course not. It would claim it carefully and document it properly. Retirement is the same. It is a financial operation. It needs good accounting. Now, let's look at married couples. And this is where the numbers really pop. If both spouses are 65 or older, the bonus is not $6,000 total. It is $6,000 per eligible person. So that becomes $12,000. Then you stack it on top of the standard deduction for married filing jointly. Then you stack it on top of the extra age-based deductions for both spouses. In the original breakdown, that total protection lands around $44,400. I'm going to say that again slowly, $44,400. That is not pocket change. That is real protection for a couple trying to make savings last. No. A practical point, standard deduction amounts can shift from year to year. So the exact total may vary depending on the IRS numbers for that year, but the big idea does not change. We are talking about protecting tens of thousands of dollars. Now here's the part that makes this benefit different from many others. This benefit is available whether you itemize or take the standard deduction. That is unusual because the tax code usually forces you to choose. You itemize or you take standard, not both. But this bonus deduction can still apply either way. So if you keep it simple and take the standard deduction, you may still get it. And if you itemize, you may still get it too. Now let's make that feel real with a couple of everyday scenarios. Scenario 1, you are retired, you don't like paperwork. You take the standard deduction every year. You still may be eligible for this bonus deduction. Scenario 2, you have high medical expenses you give to charity. You might itemize. You still may be eligible for the bonus deduction. That's why this is so flexible. It does not force you into one style of filing. It simply recognizes age and then checks income limits. Now, of course, there is fine print. There is always fine print. So let's talk about the limits. We need to cover who qualifies and for how long. This is where people get confused. So we are going to go slowly first, the timeline. This is not permanent. Let me repeat that because it's crucial. This deduction is temporary. It is only effective for tax years 2025, 2026, 2027, and 2028. That's a 4-year window, and unless it is extended, it disappears after you file your 2028 taxes. A 4-year window changes how you plan, because if you have flexibility, you may want to use the window intelligently, not aggressively intelligently. Now the second big limitation is income. This benefit is designed to help low and middle income seniors the most. So there is a phase out. Here are the key thresholds from the original story. If you're a single filer, the deduction starts to shrink once your income hits $75,000, and it disappears completely once you hit $175,000. For married couples filing jointly, the phase-out begins at $150,000, and the deduction is gone at $250,000. Now, how does the phase-out work? Here is the simple rule. For every $1,000 you earn above the threshold, the bonus deduction is reduced by $60. That means even in the phase-out range, you might still get a partial deduction, and partial still matters. Now let's make this concrete with more examples, because this is where the story becomes useful. Example A, you are single, 65 or older, and your income is $60,000. You are below the $75,000 threshold. You are likely in the full benefit zone. That means you may claim the full $6,000 bonus deduction. Example B, you are single, 65 or older, and your income is $74,000. You are still under the threshold. You may still get the full bonus. This is why knowing your number matters. Example C, you are single, 65 or older, and your income is $78,000. You are $3,000 above the threshold. 3 times 60 is 180. So your $6,000 bonus could be reduced by about 180, meaning you might still get about $5,820. Example D, you are single, 65 or older, and your income is $95,000. You are $20,000 above the threshold. 20 times 60 is 1,200. So your bonus could be reduced by about 1,200, meaning you might still get about 4,800. Example E, you are married filing jointly, both 65 or older, and your income is $145,000. You are under the threshold. You may get the full $12,000 bonus. Example F, you are married filing jointly, both 65 or older, and your income is $165,000. You are $15,000 above the threshold. 15 times 60 is 900. So the $12,000 bonus could be reduced by about 900, meaning you might still get about $11,100. Example G, you are married filing jointly, both 65 or older, and your income is $230,000. You are $80,000 above the threshold. 80 times 60 is 4,800. So the $12,000 bonus could be reduced by about 4,800, meaning you might still get about 7,200. Still meaningful. Now I want you to notice the pattern. This is not all or nothing until you hit the top. It steps down gradually and then it disappears at the upper limit. Now we are going to go deeper in the next segment. Because the most important part is not just knowing the numbers, it is knowing how to claim it and knowing what mistakes cause people to miss it and clearing up the Social Security rumor that is confusing everyone. Now you know what it is. You know the headline numbers, 6,000 for a single senior, 12,000 for a married couple when both qualify. You know the stacking idea and you know the 4-year window. So now we get to the most important part. How do you actually claim it? Because a deduction you do not claim might as well not exist. A lot of people hear about a new deduction and assume it is automatic, but that assumption is how money gets left on the table. So here is the simple 3-step guide again. And this time I am going to expand it with the real-world mistakes that cause people to miss it. Step 1, when you file your 2025 taxes, which you typically do in early 2026, you use Form 1040 Sarner. RIT is designed for seniors. It is easier to read, and it is built to make the senior-related pieces easier to spot. Now here's the part people forget. If you use software, the software still needs correct inputs. And if you use a preparer, the preparer still needs correct information. So you still want to understand the logic, because understanding prevents errors. Step 2, on that return, you check the box indicating you are 65 or older. That small check mark is not decoration. It is the trigger. If you are married and both spouses qualify, you want to be sure both are correctly indicated, because the difference between one eligible spouse and 2 eligible spouses is real money. Step 3, you complete the schedule that calculates the bonus deduction in your original story. That is Schedule 1A. This is where the 6,000 or 12,000 is calculated. This is also where the phase-out reduction is calculated. Now I want you to picture what this looks like in the real world. You sit down to file, you have Social Security statements, you might have pension statements, you might have IRA distributions, you might have interest and dividends, you might have some part-time income, and you might have a small capital gain from selling an investment. All of that flows into your income number. That income number determines whether you are below the threshold inside the phase-out range or above the top limit. So the best way to claim this correctly is to be organized, not stressed, organized. Here is a simple organization checklist you can actually follow. Collect your Social Security income paperwork. Collect your pension paperwork if you have it. Collect your IRA or 401k distribution forms if you took money out. Collect your 1099s from banks and brokerages. Collect your charitable donation records if you itemize. Collect medical expense records. If they are large enough to matter, you are not doing this to make life complicated. You are doing it to prevent the most common retirement mistake, overpaying because you did not document. Now let's talk about itemizing versus taking the standard deduction, because this is one of the biggest reasons this story works. It feels flexible, and it is. Most tax benefits force you into a choice. This one does not in the same way. You can potentially claim the bonus whether you itemize or take the standard deduction. So let's talk about what itemizing looks like for seniors. In practical terms, the only common reason seniors itemize is medical expenses. Healthcare can be the largest retirement expense category for many people. Between prescriptions, dental, vision, specialized care, and insurance, the costs add up fast. Another reason is charitable giving. Some retirees give regularly, especially when they have a stable pension or a portfolio they built over decades. If you keep good records, itemizing can make sense in certain situations. Sometimes state and local taxes factor in. Sometimes mortgage interest does. Sometimes it is a mix of several items. The point is not that everyone should itemize. The point is that this bonus deduction does not punish you if you do. That is why it is so broadly useful. Now I want to expand on the 4-year window, because this is where strategic thinking matters. Not aggressive, strategic. If you have years where your income jumps, you should pay attention. Income jumps can happen for very normal reasons. Maybe you sell a position that has grown for years. Maybe you sell a rental property. Maybe you take a larger IRA distribution because of a big expense. Maybe you do a Roth conversion in a year you thought was quiet. Maybe you take part-time work when prices rise. Any of those can push income upward. And if you are near the phase-out thresholds, it can shrink the bonus deduction. So here is the planning mindset I want you to adopt. Know your approximate income before the year ends. If you are close to the thresholds, be careful about moves that can push you across them. That does not mean you avoid good decisions. It means you avoid accidental decisions. For example, if you are single and your income is around $74,000, you might be in the full benefit zone. If you add a one-time distribution or a capital gain, you could slip into the phase-out range. You might still get a partial deduction, but not the full. For a married couple near $150,000, same idea. If you are at $148,000, you might be in the full benefit zone. If you take a sudden extra distribution, you might start reducing the bonus gain. It is not all or nothing immediately, but it is still money and it is still worth knowing. Now let's make this very practical with 3 more income scenarios, because this is where people finally say, I get it. Scenario 1, single 65 or older, income is $62,000. You are below the $75,000 threshold. You likely qualify for the full $6,000 bonus. That is simple. Scenario 2, single 65 or older, income is $88,000. You are $13,000 above the threshold. 13 times 60 is $780. So your $6,000 bonus may be reduced by about $780. You might still get roughly $5,220. That is still substantial. Scenario 3, married filing jointly, both 65 or older. Income is $190,000. You are $40,000 above $150,000. 40 times 60 is $2,400. So the $12,000 bonus could be reduced by about $2,400. You might still get roughly $9,600. Still meaningful. Now here is why I keep repeating the phrase, do not leave money on the table. Because even a partial deduction is money you do not have to hand over. Now, before we go into the Social Security rumor, I want to cover common mistakes, because mistakes are what turn a benefit into nothing. Mistake 1, assuming it is automatic and never checking the forms. Mistake 2, not indicating age properly on the return. Mistake 3, using the wrong filing status when it changes what you qualify for. Mistake 4, for married couples, not realizing the bonus is per eligible person. $6,000 for each eligible spouse. Mistake 5, not understanding the phase out and being shocked when the bonus is smaller. Mistake 6, believing internet rumors and making decisions based on them. Which brings us to the rumor that has been spreading everywhere. People are saying this new deduction completely eliminates all taxes on Social Security benefits. So is that true? Number, it is not true. And in the next segment, I am going to explain it in a way that is easy to understand, because misunderstanding that point can lead to costly mistakes. Let me be absolutely crystal clear. The rumor is false. This deduction does not directly remove the tax on your Social Security benefits. The rules for how Social Security is taxed are still the same. What changes is your overall taxable income after deductions. So what does this deduction actually do? It lowers your overall taxable income. And by lowering taxable income, it can indirectly reduce the amount of income that gets taxed, and that can indirectly reduce how much of your Social Security is subject to tax. But it is not a magic wand that makes Social Security automatically tax-free. Now, why do people get confused? Because the end result can look like magic for some retirees. When deductions are large and income is modest, the federal tax bill can end up at zero. So people assume Social Security must have become tax-free. But that is not what happened. What happened is your taxable income got low enough that your tax owed became zero. That is an important distinction, because if you believe the wrong story, you might take the wrong action. Now let's bring this home with dollars and cents, because that is what actually matters to a household budget. A $6,000 deduction is not $6,000 in cash. It is $6,000 that may not be taxed. So the value depends on your tax bracket. Here are simple examples that make it real. If you are in a 12% bracket, a $6,000 deduction can save about $720. If you are in a 22% bracket, it can save about $1,320. If you are in a 24% bracket, it can save about $1,440. Now for married couples who qualify for the full $12,000, you can roughly double those savings. At 12%, about $1,440. At 22%, about $2,640. At 24%, about $2,880. That is real money. It is not a theoretical benefit. Now let me translate those numbers into real life. $1,700 can cover multiple months of prescriptions for some people. $1,300 can cover insurance premiums, a dental bill, or a major car service. $2,000 to $3,000 can be a meaningful cushion when living on a fixed income. And that is why this is not a small change. It is a tangible relief lever. Now let's recap the key points again, because repetition is how people remember. First, you have to be 65 or older. Second, it is available even if you are still working part-time, as long as your income is within the limits. Third, it works whether you itemize or take the standard deduction. Fourth, watch the phase-out limits carefully. Single starts phasing out at $75,000 and disappears at $175,000. Married filing jointly starts at $150,000 and disappears at $250,000. Fifth, this is temporary. It is only available for tax years 2025 through 2028. Now I want to add one more planning thought that can save people from regret. A temporary deduction changes how you approach timing. If you have flexibility in when you recognize income, this 4-year window matters. If you have a large one-time transaction, you can schedule. The window matters. If you have a year where income will be unusually high, the window matters. I am not telling you what to do. I am telling you what to watch because attention is how you keep money. Now let's talk about scams. Because scams are guaranteed to follow anything that benefits seniors. Here's how the scam usually sounds. They will say, "We can help you claim your senior bonus." They will say, "You must act immediately." They will say, "Pay a fee to unlock it." They will say, "Confirm your Social Security number to process it." They will say, "We are calling on behalf of the IRS. Be careful, do not give personal information to a stranger who contacted you first. Do not pay someone just to access a deduction. The forms and information are available for free, and reputable tax software typically guides you through the inputs if you answer correctly." If you want help, use a trusted tax professional, not a cold call, not a random text, not a pop-up ad pretending to be official. Urgency is a classic scam tool. Real tax filing does not require panic. It requires accuracy. Now, let's finish with a simple action plan you can actually follow. Step 1, write down the key numbers now. $6,000 for a qualifying single senior, $12,000 for a qualifying married couple where both are eligible. 4-year window from 2025 through 2028. Phase out starts at $75,000 single and $150,000 joint. Step 2, before you file, make sure your age status is correctly indicated. And if you are married, make sure both spouses are properly accounted for. Step 3, if your income is near the threshold, pay attention before the year ends, because once the year ends, you cannot undo income choices. Step 4, when you file, do not assume it is automatic. Check that the bonus deduction was actually calculated. That is the difference between hearing a story and getting the benefit. Now let me leave you with the thought that matters most. Please do not leave money on the table just because the tax code feels intimidating. This is a benefit designed to help seniors. So use it, claim it correctly, and keep what you are entitled to keep. And that brings us right to the final question. This is a 4-year window of opportunity. A window that, as of right now, is set to slam shut after 2028. Knowing that this huge benefit has an expiration date. What is your plan to make the absolute most of it while you can? Now I want to slow down and make the stacking idea feel even more real, because stacking is the whole reason people get excited about this. Most deductions are isolated, you get one, and that is it. This is different because it layers standard deduction, plus the age-based deduction, plus the new senior bonus deduction. And when you layer deductions, you are not playing a trick. You are simply recognizing that the tax code allows multiple protections at the same time. Now let me connect this to everyday retirement life. Because retirement income is often a mix. Some of it may be Social Security, some of it may be a pension, some of it may be IRA distributions, some of it may be interest and dividends, some of it may be a little part-time work. When income is mixed like that, deductions become a stabilizer. They reduce the portion that is taxable, that can smooth out the tax impact of a year that otherwise would feel tight. Now let's talk about itemizing in a way that actually matches how seniors live, because this story is powerful partly because it works either way. If you take the standard deduction, you may qualify. If you itemize, you may qualify. So what does itemizing look like for many seniors? Medical expenses, and not just one category. Prescriptions, specialist visits, dental work, vision, mobility equipment, insurance costs. These are normal expenses in retirement. They are not luxuries, they are life. Another big one is charitable giving. Many people keep giving in retirement. Sometimes it is part of their identity. Sometimes it is tied to a church, a community, or a cause. So if you itemize because medical expenses and giving are meaningful, this bonus can still matter. That flexibility is rare, and that is why it is worth understanding. Now I want to add a very practical point about the 4-year window. A temporary rule changes behavior for people who plan. If you have a year where income will be higher than normal, you may want to be aware of that before it happens, not to avoid good decisions, but to avoid accidental decisions. For example, I have seen people sell a large investment position in December. Then they find out in March that it reduced a benefit they could have had. If they had sold part in December and part in January, the benefit could have been different. Not always, but sometimes. I am not telling you to do that. I am telling you why timing matters when rules have thresholds. Now let's go even deeper with more phase-out examples, because this is where people really understand the formula. Single example 1. Income is $75,000. Exactly. You are right at the threshold. That means the bonus is not reduced by the phase-out formula. You may still be in the full bonus zone. Single example 2, income is $76,000. That is $1,000 above the threshold. Don't times 60 is 60. So your $6,000 bonus might be reduced by 60. That means about $5,940. Single example 3, income is $81,000. That is $6,000 above the thresholds. 6 times 60 is 360. So your bonus might be reduced by about 360. That means about 5,640. Single example 4. Income is $110,000. That is $35,000 above the threshold. 35 times 60 is 2,100. So your bonus might be reduced by about 2,100. That means about 3,900. Married example 1. Income is $150,000. Exactly. You are at the threshold. That means the $12,000 bonus is not reduced by the phase-out formula. You may be in the full bonus zone. Married example 2. Income is $151,000. That is $1,000 above the threshold. Don't times 60 is 60, so the $12,000 might be reduced by about 60t. That means about $11,940. Married example 3, income is $180,000. That is $30,000 above the threshold. 30 times 60 is 1,800. So the 12,000 might be reduced by about 1,800. That means about 10,200. Married example 4, income is $240,000. That is 90,000 above the threshold. 90 times 60 is 5,400. So the 12,000 might be reduced by about 5,400. That means about 6,600. Still meaningful. Now notice the theme. The benefit shrinks gradually, and then it disappears at the upper income limit. That is why you should not assume you get nothing just because you are above the threshold. Many people in the phase-out range still get a real deduction, and that real deduction still reduces tax. Now we can move on, because knowing the math is good, but claiming it correctly is what actually produces results. Now, let's go deeper on the claiming steps, because this is where people lose the benefit. Not because they are careless, because they are rushed. When you file, you want to make sure 3 things happen. 1, your age status is correctly indicated. If you are married and both qualify, both are correctly indicated. 2, the bonus deduction is actually being calculated on the appropriate schedule. Not assumed, not guessed, calculated. 3, if you are in the phase-out range, the reduction is applied correctly using the formula. Now I want to add another set of real-world mistakes, because these are common mistakes. Number 1, people assume their software automatically finds every deduction. It does not if you enter something incorrectly. Mistake number 2, people forget that the bonus is per eligible person for married couples. That detail matters. Mistake number 3, people confuse deductions with credits and expect a refund equal to the deduction. Then they think it did not work, but it did work. They just misunderstood what a deduction does. Mistake number 4, people misunderstand the Social Security rumor and plan their cash flow around a false idea. That is dangerous. So let's restate the truth one more time, in the simplest way possible. This does not directly make Social Security tax-free. It lowers taxable income. Lower taxable income can reduce tax, and that can sometimes result in a zero federal tax bill for modest incomes. Now I want to add one more planning layer because this is a 4-year window, and windows reward preparation. If you have flexibility, you may choose to watch income timing during 2025 through 2028, not for games, for awareness. Here are the types of events that can raise income unexpectedly. Large IRA distributions, large capital gains, Roth conversions, selling a property, taking on part-time work. Again, the point is not fear. The point is that if you understand thresholds, you can make decisions with full information. Now let's talk about what this means in actual taxes again, using more brackets so it feels real. If you are in the 10% bracket, 6,000 times 10% is about $600 of savings. If you are in the 12% bracket, it is about $720. If you are in the 22% bracket, it is about $1,320. If you are in the 24% bracket, it is about $1,440 now for married couples with the full $12,000. You double those numbers, and you start to see why people call it a big deal. Now let's connect savings to real expenses again. A few $100s can cover a utility bill stretch. $1,000 can cover a major medical copay. $2,000 to $3,000 can protect your emergency fund from being drained. That is why this is not an abstract accounting trick. It is real relief for people who live on fixed income. Now we need to finish with the scam warning. And I want it to be very specific because scammers thrive on confusion. Here are the most common scam lines you may hear. We can unlock your senior bonus deduction for a fee. We can file special forms for you if you pay now. You must confirm your Social Security number to claim it. The IRS needs your bank information immediately. Be careful. Do not pay a stranger to access a deduction. Do not share personal information with someone who contacted you first. And do not trust urgency. Good financial decisions are calm. Scams feel rushed. Now let's bring everything home with the key points one last time. You must be 65 or older. It applies during tax years 2025 through 2028. It stacks on top of other deductions. It can apply whether you itemize or take the standard deduction. It phases out above the income thresholds, and you have to claim it properly when filing. Now here is the final question again, because this is the thought that should stick. This is a 4-year window of opportunity, a window set to close after 2028 unless extended. So knowing that this benefit has an expiration date, what is your plan to make the absolute most of it while you can?